Welcome to the Deep Dive. Our mission today is pretty focused. We're taking a look at Procter & Gamble's latest annual report, the Form 10-K for fiscal 2024. We've got excerpts here, and we're going to unpack the key bits of insight.
That's the plan. Think of it as getting the highlights on P&G's performance, their strategy, where they're headed, straight from the horse's mouth. We'll dig into what they say drives their business, how that showed up in the numbers, and what they're focusing on now.
Exactly. So let's get into this material together. What really jumps out from these documents about this, massive consumer goods company? It seems like the core strategy revolves around something they call irresistible superiority.
Irresistible superiority, yeah, it's quite the phrase. And what it means, according to the report, is winning across 5 specific things. The product itself, the package, the communication or advertising, retail execution, how it shows up in store or online, and value. They want their stuff to be so clearly better that, people just keep choosing it.
So it's the whole picture, not just, does the soap clean? It's also, is the bottle easy to use? Does the ad stick with you? Is it easy to find? And does the price feel right for what you get?
Precisely. And the report emphasizes this isn't a one-and-done thing. It takes continuous investment.
Right. They have to keep proving they're superior.
They do. They're constantly measuring their brands on those 5 points, using data, testing, and then investing to stay ahead.
Okay, but investing costs money. So how do they pay for that, especially with things like raw material costs bouncing around or currency issues?
That brings us to the other big piece, productivity. The report calls productivity the fuel for that investment, but it's also key for, handling those costs, dealing with currency headwinds, boosting margins, and generating cash.
So it's more than just finding ways to save money.
No.
It's about running the whole operation more efficiently.
Exactly. The document's pretty clear. Productivity is more than cost-cutting. It is a more efficient way of operating. They talk about aiming for big savings in cost of goods sold, getting back to pre-pandemic levels of efficiency.
And that connects to things like their Supply Chain 3.0 initiative.
Definitely. That's a huge part of it.
Is there a good example in a report of what that efficiency looks like in practice?
Yeah, there's a really striking one about checking in shipments. What apparently used to take 2 people 2.5 days.
Wow.
Can now, with automation and digital tools, be done in as little as 10 minutes.
10 minutes. That's incredible.
It's a massive time saving, over 99%. Think about better truck use, less labor cost, faster cash flow. It really shows what they mean by efficiency.
Okay, that definitely makes the concept concrete. So this overall framework, they mentioned portfolio, superiority, productivity, organization, and something called constructive disruption. That's their integrated growth strategy.
That's it. And leading constructive disruption seems pretty important to them, especially given how competitive and, unpredictable the world is. It's about shaking things up themselves.
Like the fabric care example they brought up.
Exactly that one. They've been pushing concentrated ingredients, same cleaning power, but less weight, less water, less plastic.
So lower costs for them, better for the environment potentially, and still works for the consumer. That is disruptive.
Right. It changes the game a bit, potentially drives growth for them in that segment, and maybe sets a new standard.
So beyond that core strategy, the report pulls out 4 other focus areas for execution.
Yep.
Supply chain, which we touched on, environmental sustainability, digital acumen, and the employee value equation.
Yep. We talked about supply chain 3.0 efficiency. Environmental sustainability, they frame that as being built into the business, making products superior by being more sustainable.
Like the Lenore Unstoppables example.
Yeah.
With the packaging.
Perfect one from the report. They switched to cardboard, which cut plastic. Consumers apparently found it easier to use, so that's a superiority win, and it helped drive a 40% sales bump for that product, helped the whole category grow.
Huh. So sustainability can actually boost superiority and productivity. Interesting link. What about digital acumen?
Well, they're using data and digital tools everywhere, understanding consumers, working with retailers, optimizing the supply chain, even R&D. They mentioned their India operations as an example.
Oh, yeah. What do they do there?
They use data and automation to cut the number of touch points in their supply chain by 60% over just a few years. Plus, they rolled out an AI ordering system for distributors, which made predictions better and faster.
And did it help sales?
Seems like it. Sales in India grew over 8% a year on average for the last 3 years. So, yeah, better digital operations can definitely link to growth.
Makes sense. Smoother, faster operations driving sales.
Yeah.
And the last one, employee value equation.
That's all about getting and keeping the best people. The report talks about competitive pay and benefits, naturally, but also building an inclusive culture. They see their employees as a key advantage for actually making the strategy happen.
Okay, that gives us a good handle on the strategy and focus areas. Let's pivot to performance. How did this all play out across their business segments in fiscal 24? They've got 5 main ones, right?
Correct. Beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care.
And fabric and home care is still the biggest.
Yep, brought in 36% of net sales in FY24.
Huh.
Then beauty at 18%, healthcare 14%, baby, feminine, and family care also 14%, and grooming was 8%.
Okay. And how did they do overall on the top line?
Net sales were up 2% overall, hitting $84 billion. But if you look at organic sales, which takes out currency effects and portfolio changes, growth was 4%.
A 4% organic growth.
Yeah.
What drove that? According to the report, was it more people buying P&G stuff?
Mostly pricing, actually. Price increases added 4%, volume, so the actual amount of stuff sold, and mix were basically flat compared to the year before.
Huh. So price hikes drove the growth.
Pretty much. Then unfavorable foreign exchange rates knocked off 2%. Which gets you back to that reported 2% net sales increase.
Okay, so sales are up because prices are up, but the quantity sold didn't really change. What does that suggest about that superiority idea? If volume is flat, are consumers pushing back on price or just accepting it?
That's a really key question, isn't it? Flat volume means either the higher price is okay because the product feels that superior, or maybe elasticity is kicking in, and the price hikes are preventing volume growth they might otherwise have seen. It's definitely a balancing act.
How did that organic growth look across the segments? Was it even?
Not really. Grooming was high single digits. Fabric and home care and healthcare were mid-single digits.
Yeah.
And then beauty and baby, feminine and family care came in at low single digits.
Okay. Does the report give examples of brands where superiority did seem to drive growth beyond just price, like actual volume or value growth?
It does highlight a few. Always Flex Foam Pads apparently had mid-teens organic sales growth and helped grow the whole category.
And teens is strong.
Yeah. And Native, that premium personal care brand they bought its sales, apparently grew almost 10 times over 5 years. It hit over $700 million in FY24, and they say it's driving value growth in things like deodorant.
Wow. 10x growth for Native definitely suggests people are buying into what it offers.
Absolutely. And in home care, they point to Cascade Platinum Plus pods. Growing sales, growing the category. Part of the pitch is skipping the pre-rinse, which saves water. That's a tangible value, right? They say it's a big chunk of the category's growth.
Right. Convenience and sustainability tied together.
And Lenore Unstoppables, with that packaging change we mentioned, a 40% sales lift attributed just to that change, also helped grow the category.
Those are good examples of innovation paying off beyond just raising the base price. And the report mentions their strong market shares too.
Oh yeah. Global leader in grooming, over 45% share, and over 60% in blades and razors specifically. Fabric care leader, over 35%, baby care, over 20%, feminine care, over 20%. And in North America, Bounty has over 40% share in paper towels, Charmin over 25% in bath tissue. Holding those positions is obviously critical.
Okay, let's turn to the overall financials for FY24 versus FY23. Net sales up 2%. How did that filter down to profit?
Well, operating income was also up 2%, reaching $18.5 billion. Net earnings were up 2% as well to $15 billion. And diluted earnings per share up 2% to $6.02. But they also highlight core EPS, which strips out some items like restructuring and impairments, and that was up 12% to $6.59, a much bigger jump.
12% core growth is pretty solid. What were the main things helping and hurting that reported 2% operating income growth?
The sales increase was the main help, but dragging it down was a pretty big non-cash impairment charge, $1.3 billion, related to the Gillette intangible asset.
Right, the Gillette charge.
Yeah.
Does the report connect that impairment back to the challenge of keeping that superiority edge in a tough market like grooming, even as the leader?
It mentions market conditions and competitive factors affecting the long-term view for that asset value. So yeah, implicitly, it ties back to the constant fight to maintain leadership and value against competitors and changing tastes in that specific segment.
Got it. And for net earnings, you mentioned core EPS was much stronger. What else affected the reported number?
Yeah.
Was there a tax impact?
Yes, the effective tax rate went up a bit from 19.7% to 20.2%. They said that was mainly due to where the profits were earned geographically, an unfavorable mix.
Okay.
And the report also flags that foreign exchange, the currency swings, reduced net earnings by about $589 million in FY24. That's a decent shock.
So higher sales helped, but that Gillette impairment, higher taxes, and bad FX really weighed on the reported net earnings. What about costs generally? Did margins improve?
Gross margin did improve, primarily because of the higher prices, but also productivity savings and a favorable product mix. Those managed to outweigh higher input costs and the negative FX impact on costs.
Okay, so productivity helped there. What about SG&A, the selling, general, and admin costs?
Those actually went up, mainly due to more spending on marketing and overhead.
But productivity helped offset some of that too.
It did, yeah. Productivity savings gave them a 60 basis point benefit to SG&A as a percentage of sales. They also specifically mention wage inflation as pushing up overhead costs.
Okay.
And there were restructuring costs too, $659 million in FY24, which included some non-cash currency losses from exiting certain markets.
Right, that financial picture shows the moving parts pretty clearly. Let's talk cash flow. That's often a real strength for companies like P&G. How do they do?
Very strong. Cash flow from operating activities hit $19.8 billion in FY24. That's up 18% from the year before.
An 18% increase is quite a jump. What fueled that?
Well, the starting point is net earnings, adjusted for non-cash stuff like depreciation, amortization, like Gillette impairment, stock compensation that generated about $19.3 billion. Then positive changes in working capital added another $500 million or so in cash.
What improved in working capital?
Mainly, they stretched out payments to trade suppliers linked to more marketing support and just negotiating longer terms. That was partly offset by paying suppliers less for materials due to falling commodity costs, and also receivables went up a bit with sales growth.
Okay. The report also mentions adjusted free cash flow. That's a key metric for them.
Yeah, they define it as operating cash flow minus capital spending and certain tax payments. They see it as, the cash that's really available for things like dividends, share buybacks, maybe acquisitions.
And how did that look?
Really good. $16.9 billion in adjusted free cash flow, up 21% year over year, mainly because operating cash flow was so strong. And their adjusted free cash flow productivity was 105%.
Meaning they converted over 100% of their adjusted earnings into free cash flow.
Exactly. That's a metric they track closely, kind of a measure of management effectiveness on cash conversion.
Generating that much cash relative to earnings is definitely strong. So what does the report say they do with all that cash? Especially thinking about shareholder value.
Well, their number one stated use is dividends. P&G is, famous for its long history of paying and increasing dividends.
Dividend stalwart.
Yeah.
And buybacks. Share repurchases.
Also a big part of it. They use buybacks to return cash, offset stock issued to employees, that sort of thing. In FY24, they bought back $5 billion worth of shares.
$5 billion.
That was under a program that just finished at the end of June 2024. It was sort of at the low end of the $5 to $6 billion they expected for the year, financed mostly by operating cash and some debt.
So significant cash returned to shareholders via both dividends and buybacks. Okay, looking ahead now. How does the report frame P&G's position and the risks they see?
Management sounds pretty confident in their overall strategy. They believe focusing on daily use products, combined with that superiority productivity engine and being agile, sets them up to perform well in, as they put it, any environment.
Sounds confident. But the report must also list the challenges, right? The risks.
Oh, definitely. It acknowledges the environment is highly competitive, volatile, lots of risks listed.
What are some of the big ones they highlight?
Macroeconomic uncertainty and foreign currency swings are huge. Over half their sales are outside the U.S., so changes in exchange rates can really hit the reported dollar numbers for sales, earnings, cash flow.
Which we saw happen in FY24.
Exactly. Commodity price swings and cost pressures are another constant risk. Think about oil-based chemicals, paper pulp. They manage it with productivity, sourcing, pricing. But pricing, as we discussed, can affect volume.
Are supply chain disruptions still a major worry?
Still listed as a risk, yeah. Even with improvements like Supply Chain 3.0, things like geopolitical issues, natural disasters, health crises, those could still cause problems.
Oh, so regulation.
That's a big category.
Yeah.
Product safety rules, environmental compliance, new reporting rules around sustainability and non-financials, different regulations in different countries. They do note, though, that they don't expect current regulations to have a material impact on their spending, earnings, or competitive stance in FY25.
Okay. And just the general competitive landscape.
Intense. Global players, local brands, store brands. They have to compete hard on price, promotions, innovation, and managing relationships with powerful retailers, especially as they consolidate, is critical. E-commerce channels add another layer of complexity.
Reputation is always key for brands like theirs.
Absolutely critical. Any issue with product quality, safety, ingredients, packaging perceptions, even social media buzz or labor issues could really damage a brand.
And the need to keep innovating. That's a risk if they fall behind.
For sure. Their whole strategy relies on superiority. If they don't innovate effectively or can't counter competitors' moves, that strategy gets undermined. And finally, they mention attracting and keeping the right talent as essential to execute everything.
So it's a complex picture. Strong strategy, good cash generation, but facing a whole web of external pressures and risks they need to navigate constantly.
Yeah, the report paints a picture of a company that knows its strengths, but is also very aware of the challenges in the operating environment.
So wrapping this up, what are the main takeaways after this deep dive into the P&G 10K sources?
Well, we've definitely seen a company sticking to a very clear integrated strategy. It's all about irresistible superiority for their daily use products, fueled by a relentless focus on productivity to pay for that superiority and manage costs.
And the financials for FY24 reflect that. Growth came mainly from pricing. Cash generation was very strong, allowing them to send a lot back to shareholders through dividends and buybacks, even with things like that Gillette impairment and FX headwinds.
But as the report spells out pretty clearly, the world they operate in is tough, highly competitive, volatile. So challenges like currency swings, cost fluctuations, the need to constantly innovate, adapt to regulations, changing consumer habits, those aren't going away.
Right. And those focus areas, supply chain, digital, sustainability, employee value, that's where they're doubling down to make sure the strategy keeps working despite those challenges. This dive really gives you a solid view of how P&G sees itself and its performance, based right on their own words.
You know, here's maybe the really interesting dynamic to think about. P&G is aiming for irresistible superiority that inherently costs money, R&D, marketing, better packaging. It all requires investment to stay ahead. At the exact same time, they're laser focused on productivity, which, let's be honest, often means cutting costs, streamlining, becoming more efficient.
So investing to lead versus cutting costs to be lean.
Exactly. There's this constant tension, right? Investing heavily to innovate and win while simultaneously driving efficiency programs and cost savings, all while managing global volatility and shareholder expectations for returns. How do you strike that balance perfectly?
Yeah, that balancing act. Investing for the long term versus delivering efficiency now, especially when you have shareholders wanting returns today. How do companies like P&G make those trade-offs? It's something maybe you face in your own decisions too. Definitely something to chew on after this deep dive.